Hello students, today we will be discussing one of the important capital structures theories, that is Modigliani and Minar's approach. As you have been discussed in my other video, that what are the different types of theories. Out of that, one of the important theories is the Modigliani-Minar approach. So under this approach, there are two types of things. One, it has been designed in the year of 1958, that is approach 1958, and that is without tax. Another is the approach 1963 with tax. First of all, we will be discussing the approach 1958 without tax. You see that every concept has based upon some fundamentals. So here is also certain things are they have taken, that the approach describes in a perfect capital market where there is no transaction cost and no taxes. That is the pre-assumptions, rather you can talk it that thing. This approach describes in a perfect capital market where there is no transaction cost, tax. The value and cost of capital of a company remain unchanged irrespective of the change of flow. So another point is that your value and cost of capital of a company remain unchanged irrespective of the change in the capital. Whatever way you change in the capital structure, your value and cost of capital will not change. So this approach is further based upon the following assumptions. See, these are all simple way. The capital market are perfect. These are all assumptions. All information is freely available and there is no transaction cost. All investors are rational. All favorable thinkings they do have. Firms can be grouped into equivalent risk classes on the basis of their business risk. Equivalent risk class. No existence of corporate tax. By the approach name itself, the no tax. No existence of corporate tax. From the above assumptions, approach derived the following three propositions. What are those propositions? First proposition, they are telling that the total market value of a firm is equal to its expected net operating income divided by the discounted approved the risk class decided by the market. What does it mean? That means value of the firm equal value of the levered firm equal to the value of the unlevered firm. What does it mean, levered firm? Where that capital structure includes the debt capital, and unlevered firm where only equity capital will be there, no debt capital will be there. So in such situation, value of the firm equal to net operating income by cost of capital, KO, overall cost of capital. This is one. Again we are repeating, the market value equal to the expected net operating income divided by the discounted rate appropriate to its risk class decided by the market. Simply, value of the firm is equal to NOI, net operating income, by cost of capital, overall cost of capital. Second point they have the proposition, a firm having debt in capital structure has higher cost of equity than an unlevered firm. So this is also another very important point, that a firm having debt in capital structure is higher cost of equity than an unlevered firm. So unlevered firm there is no debt capital. So in such situations, when there is a debt in capital structure, higher cost of equity, in such situation equity capital cost will be more. The cost of equity will include the risk premium for the finance risk. So risk premium will include the cost of equity in a levered firm is determined as under. So levered firm matlab there is the equity as well as the debt capital. So cost of equity equal to overall cost of capital plus overall cost of capital minus cost of debt capital into debt by equity. So this is the second point for that. And the third important point, they are telling that the structure of the capital, that is financial leverage, does not affect the overall cost of capital. The cost of capital is only affected. You see that structure of the capital, that means whether there is a debt capital or not, for that overall cost of capital it will not impact. So this cost of capital is affected by the businesses only. So what way they are showing this way? This is the one diagram they are showing. This is the x axis, they are taking the degree of leverage, y axis they are taking percentage. So you see that cost of debt capital, definitely it will remain unchanged. Cost of equity, that is increasing, as we have told, no, where there is the debt is there, cost of equity capital will be more. And KW, what is that KW? Average cost of capital. You see that very interesting thing. In such situation, though your cost of equity is increasing under the circumstances when there is a debt in the capital structure, but the overall cost of capital also remains constant. There is no change. That is the thing. So this is the basics of your this MM hypothesis without tax. So now we'll be going for this thing. Subsequently, they thought that market conditions always there will be tax. Without tax, nothing you can think over. So that's why this MM hypothesis subsequently in the year 1963 it has been changed little way. So what is that change comes? That we'll be discussing now. You see that this part already we have discussed, MM approach 1958 without tax. Now we will be discussing that MM approach 1963 with tax. There is the some shortcomings were in your 1958 without tax. So subsequently what they have developed that thing, tax has been added with this format or with this theory. You see, what does that MM approach with tax? As they realize that, they Modigliani Miller realize that the value of the firm will increase or cost of capital will decrease where corporate tax exists. You see, here one new thing has come. You see that they realize that the value of the firm will increase definitely, or the cost of capital will decrease where the corporate tax exists. Value of the firm definitely will increase and cost of capital decrease where the corporate tax exists. This is one point. What will happen? As a result, there will be some difference in earnings of equity and debt holders in levered and unlevered firm. See what they are telling, that as a result there will be some difference in earning of equity and debt holders in levered and unlevered firm. You see that in case of levered firm only debt and equity will be there, unlevered firm no question of debt, but there will be some difference in the earning of equity and debt holders in such situations. Now another point they are telling that thing, the value of liver farm will be greater than the value of unlivered farm by an amount equal to amount of debt multiplied by corporate tax. So what they are telling here, you see that the value of a liver farm will be greater than the value of an unlivered farm. That is, where the debt in that capital structure, that value will increase those farms in comparison to an unlivered farm by an amount. Which amount? Equal to the amount of debt multiplied by corporate tax. That means amount of debt into corporate tax. See, these are all new things they have developed in their 1963 format. So, in such situation, cost of capital equal to K0, cost of equity of the liver farm number 1, value of liver farm or company, whatever the way you can call, equal to value of liver farm plus tax. So what is that